What do you do if you're trading with a dollar cost averaging approach and the trade goes horribly wrong? You're in a trade or a collection or basket of trades where you've averaged into a long or short position and the trade has gone further and further against you. What are you supposed to do in this situation? Without a stop loss, oftentimes traders get themselves into a lot of trouble because they are trying to dollar cost average and they're making some simple mistakes that you can very easily avoid if you approach this with proper risk management. So in this video, we're going to be discussing how to handle trades gone wrong when you're employing a dollar cost averaging approach. Now, if you're unfamiliar with a dollar cost averaging approach, let me give you a quick example. Instead of shorting the euro pound here with a tight stop loss just below structure, a dollar cost averaging trading style would instead choose to short multiple different times in small increments, building an overall short position, and then ultimately closing the trade when the trade has moved back in our favor. Now, this style of trading is not for everyone, and I want to disclaim before we go any further in this video that this strategy carries risk like everything in trading. Whether you're using a stop loss or not, you can lose a ton of money trading if you approach it inappropriately or without good risk management strategies. And contrary to popular belief, a stop loss is not the only way to manage risk. In fact, the ultimate way to protect risk in markets is ultimately small position sizing, because even a stop loss can be slipped very poorly in the environment that volatility expands rapidly and prices gap in one direction. Small position sizes are ultimately the best defense to trades gone wrong, and we could pretty much cut the video there. With small enough size, you can stomach most things. With too big of a size, it is very easy to blow up with or without a stop loss. So let's talk about a trade gone right really quick before we jump into a trade gone wrong. Let's say the example that we just did, we took a short position and let's say we proceeded to add a second and even a third short position before the market ultimately reversed lower, and between the three trades that we had taken, we were able to close out a profit on our basket of three short positions over here. And with us being in the replay mode, we can actually go ahead and just give another quick example that I wanted to show you. Let's say, for example, that we wanted to get short on the euro pound. The ultimate factor here is going to be our size of the trade. By placing small enough trades, these drawdowns are survivable. But if your trade size is too big, it is only a matter of time when trying to use dollar cost averaging to blow your account. So instead, let's say that we take a small 1K units or 0.01 lot size short position on the euro versus the British pound. And let's just say, as the example goes, that the trade actually works against us, that we move against us. We are only down a total of $7 on this position now. Even though on the daily chart we've had a big push higher, this really mutes the volatility in our account by having such a small trade size. So let's say that, we're in the short position and it keeps going against us. And let's say at this point, our rules, which I'm not going through the criteria of the rules at this time that I use, but I have put together a rule set that I use in this video that will pop up in the top right if you'd like to check out the full dollar cost averaging strategy video that I did. But this is particularly about dealing with trades gone wrong. Let's say in this situation, however, this meets our criteria and we enter our second short position. What you'll see here is that our dollar cost averaging just worked in the upwards direction, where we took an initial short here, a second short here, and our average cost has now been moved higher up to 85.62 on the euro British pound. Also really quick, I wanted to tell you guys about the sponsors of this video. Whether you're in the US or outside of the US, I wanted to tell you about two of my favorite Forex brokerages and some of the great free perks that they're offering right now. The first one is ACAP, which is a broker outside of the United States that offers Forex internationally to traders all over the world. They're regulated by ASIC and SCB. They offer Forex pairs, crypto, CFDs, stocks. They have low trading fees, trade directly on TradingView.com. Unfortunately, they are not available to US clients. I'll leave a link in the description if you want to check out ACAP. It is, like I said, my favorite international brokerage for traders outside of the US. The second one is for my US traders. This is the brokerage brokerage that I have used for a number of years. It's Oanda, and we'll leave a link in the description down below if you want to check them out. They're also well regulated. They offer very low trading fees, and you can trade a good collection of things now on there. Forex pairs, they also now offer some crypto. And the downside is there's not a ton of leverage, but based on what we're talking about in this video, we don't need a whole lot of leverage. So I'll leave a link in the description to both 8cap and Oanda down below in the description. And make sure to check out those links down below in the description specifically because they have some special offers available only to my subscribers. Check it out down below. And make sure to use the specific links in the description down below for both Oanda and 8cap because we've set up some special offers just for my subscribers if you use those specific links down below. In this case, you can see that we have, again, the price move against us for a little bit, and let's see what happens next. So price moves sideways, and ultimately at this point, we could close the trade for a very small win, right? So it wasn't big, but we worked our way out of that trade without realizing a loss. We instead realized a very small win. Nothing crazy, but we made $5 to $6 over that course of time on just this one currency pair. Theoretically, if we're doing this on several currency pairs, we could generate some nice extra income even with a small trading account. Now, if we go on to our next example, let's just say that we go for our next extreme. Let's say in this case, we then buy the market. The market has reached an oversold status, and let's just assume that fundamentally and technically, I like the trade here for upside. I'm willing to buy more if the stock or currency or commodity or whatever you're trading with a dollar cost averaging approach, doesn't really matter, moves further in the opposite direction. What you're doing with this strategy, you're not saying I need to be right away with big size and I'm leveraged to the tip of my head, right? I'm not fully leveraged on this. I'm taking a small position and I'm saying, if this moves against me, I can build. If it moves in my favor, I can take a profit. And I'm not using very much leverage, and I'm so comfortable in this because my trade size is small enough. Now, what you can see here is that had we already taken trades that were way too big, this would have already been really stressful. But we're not doing that. We're trading with very tiny size. And let's say we're looking for a modest move back higher, a base hit, if you will, back to the 8,500 level or so on the British pound or the euro versus the British pound. So the market, let's see what happens next here. It goes sideways here. And then ultimately, there we go. Let's just say we close out here and we close the position. We're up now 15 British pounds here overall on this trade. And so now let's say we reverse course. And I think this is where things are going to get interesting because this is actually kind of a trade or similar to a trade that I'm in right now, where the market has moved against me. And let's just say I take a second short position, and let's just say the market continues to move against me. And let's say I took a third short position. You can see now I'm up to 3,000 units. Just a reminder, this 3,000 units, this third trade that has gone against me, this market has trended against me for a month straight or more in this example. I'm only in a 0.03 lot size on this account. So my trade size is still tiny. This thing could go 1,000 pips in my direction and really not do much damage to the account. And that's the point. We're trading very conservatively with this approach as to not put our account in any sort of major jeopardy. So let's say that the market then, continues to push higher, and there it goes. That's the end of the trade. So we ran out of space there. But let's just say hypothetically that the trade kept going against us. Now, as long as we still like the underlying thesis, in my case, I would choose to continue to add to the trade, considering that 0.03 is definitely not a full trade size position for me. Instead, I think I have more room to add to the trade. I may be willing to do that if the trade size or the chart continued to move further and further against me. I'm not going to freak out because my trade size is so small that this move is not hurting me. Now, again, what this does is it takes timing out of the equation. It makes trading significantly less stressful, and that is the major pro. What are the cons to this? Well, of course, with inappropriate lot sizing, this can get out of hand really quick. Imagine if we had taken one lot positions each time. Then we're sitting and we're looking at a horrible drawdown very easily because we are using, again, a lot of leverage. And if you're trading with a small account, this can very easily blow you up. So what you'll see is that most of the time, especially on currencies, which is my favorite thing to dollar cost average on, we see a choppy market environment. Things tend to trade sideways over the longer term, and they don't tend to trend very well, especially on currency pairs like the Euro British Pound, which tends to move sideways. So when we reach these extreme levels, I tend to be more focused on mean reversion trades, looking for reversals and back the other direction. The next portion of this video is going to be focusing on if the chart is moving against you and the setup itself no longer looks attractive. I'm usually willing to continue to add to a dollar cost averaging position if the setup still looks attractive. Meaning, let's say I'm bullish on something and it keeps going down. As long as I'm still bullish, I'm happy to continue to add to my long position as the price moves lower. This is counter trend in nature, but personally, I am a fundamental analyst, but a lot of what I do is based on fundamental analysis and not as much heavily on technical analysis. So for me, I will still take a counter trend trade as long as the fundamental story still supports the idea of going long or short a particular asset, even if it's moving against me in the short run. Just a quick side note, George Soros, the legendary Forex trader, did this with the British pound. He shorted the British pound even though the price went against him for many months and ultimately made a killing doing this. Definitely easier said than done. And like I said, the core to this is risk management in small positions. However, let's talk about what if the setup no longer looks attractive and the market is moving against you. So let's say with the euro versus the British pound, I am fundamentally or technically or whatever your trading strategy is, just apply it here. Let's say I'm bearish on the euro pound. For me, fundamentals are a big player. So let's just say fundamentally, I think the euro versus the British pound is going to move lower. And so I get short. And then the chart starts to move against me. Let's say that I take another short. And let's just say from here, you can see I've got two positions or 20,000 units, 0.20 lots now short. I'm trading on the daily time frame. And let's say from here, something actually changes. And I acknowledge, okay, I was actually wrong about the direction of the Euro British pound. What do I do from there? Let's say that at this point, I realize, okay, fundamentally, something has changed in my rules and I'm no longer bearish on the euro pound. Traders will sometimes wonder, in that circumstance, Nick, do you just close out of everything on the spot? And the answer is no. The reason I don't is because this strategy is all about avoiding the critical timing aspects that most trading strategies obsess over, right? Timing entries, timing exits. So instead, what this strategy tends to do for me, what I do with this strategy is I wait for a better opportunity to close out. Sometimes that costs me, but remember, the trade size is so small relative to the account that it's no sweat off my back. So let's just say, for example, with a trade size of this caliber, let's say that I'm working on a $50,000 plus account. So this is just an example. Maybe you're trading with 5K, maybe you're trading with 1K. With 1K, you definitely want to trade with very, very tiny lot sizes. But let's just say, again, for my 50K account here example, I'm in 0.2 lots on a short position on the Euro British pound. And the market is moving against me, right? And I'm now thinking, okay, I no longer am fundamentally thinking this is going to go lower. In fact, I need to get out of the trade. And so what am I going to do here? Well, I'm going to look for an opportunity, if I can get it, to actually close out of this trade. But look what's happened. I'm not getting the opportunity. The chart continues to move against me. Oh no. But is it really oh no? Not really, because my trade size, like I said, is so small that I'm just floating a $346 drawdown. Or in this case, British pounds. It's such a small drawdown that it's not hurting the account. Again, people freak out about any amount of drawdown. They want to be right. They want to be in profit all the time. This strategy is not about timing. In fact, I chose this example because it's a challenging one and one that you would have to work with. The whole aspect of this strategy is it's very adaptive. It's very flexible, but it's only flexible if the trade size is small. Again, I can't reiterate this enough. Where people get this wrong is they trade with too big of a size and they can't stomach moves against them. So let me show you if we have a big move against us. At this point, you can see we're down $668. We've been just absolutely incorrect about this move on the Euro British pound. I thought it was going to move lower, and instead it's moved significantly higher against me. But at this point, even with this, which I would say this might be still slightly too big for a 50K account. I know that sounds crazy, but remember, we're trading with little to no leverage. We're trading very small. And even at this point, 668 out of our $50,000 or British pound or whatever account is still only a 1.33% drawdown. Now, again, if you were trading with 10 times the size, you'd be talking about a 13% drawdown. That's not what we're talking about here. So let's say, again, the chart moves even further against us. We're still talking about just over a 1, almost 2% drawdown in this account. Nothing crazy, even though the chart looks insane. So what do? The market has moved against us. We're clearly wrong. We should have just taken the loss. Well, you're not having those thoughts if your size is small enough that it's not causing you that anxiety, right? So yes, this chart is moving like crazy and it looks awful, but what do we know about the Euro British pound? It typically, not always, and when it doesn't, it gets you in trouble, but most of the time it tends to mean revert. And so in this case, what am I doing to get out of a trade that's going wrong? I'm just wrong about the idea. What do I do? Well, instead of cutting the losses at the worst possible time, at the top end of the move, I am in damage control. So what that means is that I am looking for this market to move back to give me an oversold reading or a pushback in the opposite direction, at least giving me some sort of fair value price to get out of the trade for a much lesser loss. So remember at this time that we are down 800 plus, maybe at one point 1,000 pounds on the downside. We're floating in drawdown, but the trade has not been closed. We're not leveraged. We're not getting our account margin called. We're trading with small enough size that we can stomach these moves. And so we're looking for an opportunity to get out, but we're not panicking just because we see red. We're trading with such a small size that it's all good and not going to destroy us, right? So then the market starts to pull back. And at this point, I am looking for the opportunity. Let's see if we get it. There it goes. We can close out of the position instead of 1,000 plus 1,200, 1,300 pounds down. We're going to close this trade at a losing value of 166 British pounds. And there you go. What did we just do there? We waited for what seemed to be an overbought market to come out of that extreme level and just close for a loss. Yes, we still took a loss, but 170 pounds or dollars is a whole lot better than the peak drawdown that we experienced during the spike that we saw over here. Now, again, what if the market keeps going? Sometimes it will. This is why your trade size is crucial in this trading style. At this point, again, even a 0.10 lot size, I would argue, is actually a very big size for even a 50K account if you plan on taking 5, 10 trades in a campaign or a setup. Like if I'm really longer term bullish on the dollar or bullish on the Aussie or something like that, and I'm building into a trade, I want to have the flexibility to build into trades. So I'm definitely not opposed to using 0.01 lot sizes. Use the minimum, use reduced risk, lower that that entry size so that you have way more flexibility to build into ideas. Now, again, I want to reiterate that dollar cost averaging is not for everybody. I have done it for 6-7 years now in the Forex market, and it is something that I prefer. Again, the trade-off being that I don't have to worry so much about timing the market and instead can really just focus on managing my risk appropriately and trying to get the overall fundamental direction right. But in this case, as you saw, sometimes I'm wrong. And even when I'm wrong, because my size is so small, I can control and work my way out of a drawdown or at least take a smaller loss. But the big thing is acknowledging, okay, I was wrong about the Euro British pound, Now I'm going to do damage control and get out of the trade for minimal damage. I showed you this example because a lot of times, even though you're wrong, the market still comes down and you can get out for a small profit or break even. But sometimes you're wrong and the market just explodes against you. And in those circumstances, which are really the topic of this video, the goal is to control damage as much as possible. And the best way to do that is to do so beforehand by taking small size, not big size. If you have big size on, these sorts of moves can blow your account. If you have tiny size, like really small trade size, 0.01 lot sizes on a good size account, these moves you can stomach and come out on top all the time. Right? You know, the way the currency market has been, if you traded, right? Let me show you something interesting about the Euro British pound. If you traded, let's go to a monthly chart. Why don't we? If you traded with small enough size on the Euro British pound, scaling in and scaling out over the past 50 years on this currency pair, it has mostly gone back and forth. It is trading currently at similar levels to what it was in 1995. The currency pair market, or the currency market, tends to mean revert over time. And so by trading these overbought and oversold extensions, is it easy? Absolutely not. Is there drawdown involved? Yes. Can you blow your accounts? Yes. The best approach that I can tell you that I've figured out with currency pairs is to do so with such small size that you do not risk or burden your account with massive drawdowns that leave you, blowing up. So that's my approach to dealing with losing trades. I made this video because I'm currently in an example similar to this on the Euro British pound. I have a currency pair that has moved against me a couple different times, and I'm in such a small drawdown. I think between all of my euro pound trades, I'm down about 1% in my account at this time. So this thing could move 1,000 pips further from me, and I'm still fine, and I can work my way out of this trade. However, now that the market is pulling back, I may get the opportunity to actually close out of the trade and take a controlled, smaller loss than had I closed at the worst possible time. So I hope this helped. This was, again, this is not a particularly popular topic in, Forex YouTube, but it is something that I've done for many years. My friend and I, Chris Pulver, who is another, he's been on YouTube for 20 years. He's an absolute trading legend. Him and I have talked, dollar cost averaging in Forex for a very long time. And it's something that we love, especially when you can get on the positive side of the carry trade and collect positive swaps for holding currency pairs over time. I hope this was helpful. Thanks for watching. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.